Hello friends, welcome back. While most people worry for a crash, I worry the stock market will not crash like what we saw in the 08, 09 and the dot-com bubble. This video will be boring as I will attempt to explain the biggest bull market is here due to an obvious arbitrage, guaranteed free money. But whenever I try to explain complicated stuff, I'll lose my audience retention and I can see it at my back-end analytics. My goal is to help as many people reach more people, so I need to balance my content. Anyway, here it goes. I'll do my best to simplify. There are three elements to explain: the CPI Consumer Price Index, the US Treasury yield, and a banana. CPI measures inflation. Inflation is the overall price of goods and services. A house that cost 100,000 20 years ago, the same house now costs $1 million. That's inflation. Like the cost of bread used to be 50 cents, now the cost is $1. That's inflation. This is cost going up, but when you need to compare charts, this chart represents a percentage change at an annual rate. US 10-year yield. In short, interest rates. The lower the yield, the lower the interest rates. The mortgage rates you are paying on your house is the interest rates. Interest rates are coming down and it will remain relatively flat and will not go back up to the 1980s. Why? In short, if they do, the US will end up spending their entire budget on paying interest. If you are a person or a company, and if you can borrow money below inflation, you have an arbitrage. It's free money. See, your cost is inflation, okay, but your cost of capital is below inflation. Let me simplify this further. If the price of a house is the cost curve represented by a banana, you see, if the interest rates are above the banana cost curve, it's expensive. But if interest rates are lower than the cost curve of a house, you can borrow a lot of money and this will cause the price of a house to shoot higher. So this is CPI versus the 10-year. I repeat, if your cost of capital is below inflation, it's guaranteed free money. You borrow as much as you can and take the debt and tie it to inflation, like a house. This is good. It's very good for stocks. And the last time where CPI exceeded interest rates was in the 1940s. I'm not allowed to share the data I have. Apologies, but the last time this happened, the stock market roared. And this was a major driver during the COVID meltdown where interest rates was effectively zero. Look, I'm not saying that the stock market will be a one-way direction up. This is the big picture. So short term, there will be dips. The midterm elections are here. Midterms are really bad for stock market, and we have the taper tantrum and we have a hawkish Fed. You see, there are lots of pressure on the stock market. So I know it can be worrisome as a new investor. That's why I always share my trades transparently here and on Twitter. I tried my very best to simplify this complicated topic. I hope you understand what I said. I hope you learn something. And as always, invest safe.